Good morning. I hope you're all very well. It's great to be with you again. We've got a good turnout today. Thank you for all of you joining despite school holidays. A lot to get through. Again, just a bumper month. It's unbelievable how volatile this year has been, how much has happened this year, and the market response. Just really, really incredible. So, jumping straight into markets. I'm reviewing the first half of 2025, so the first 6 months of 2025. And I'm sure you, like me, are amazed at the strength of returns given what we've seen. We've had Trump's tariffs, we've had immigration policy concerns, we've had rising debt concerns in the US and the rest of the world. We've had Russia-Ukraine war escalations. We've had a new war in Israel and Gaza and a new war between the US and Iran. It's just unbelievable how the new risks get added day by day by day, and the markets continue to rally to new highs. And one of the biggest market movements year to date for the first 6 months is the dollar. The dollar has had its weakest first half of a year since 1973. That's quite something. That's a big move. We're talking the biggest move in 50 years, or the weakest dollar in 50 years for the first half of a year. And you can see that on this chart, the bottom there, US cash minus 5.9%, which means that the rand has strengthened against the dollar by 5.9%. Now, the rand isn't necessarily strong right now. It's just the dollar is weak. So against the euro and the pound and other cross currencies, the rand's still looking relatively weak, or closer to fair value. It hasn't weakened as much or strengthened as much as it has against the dollar. But looking at the rest of the asset classes, I mean, some very, very nice returns. SA equities up 16%, European equities up 19%, gold up 19%. And then it's only really the US that has pulled markets down. US flat or slightly negative. Healthcare, we've spoken about. Healthcare is predominantly US, 70% US. And then there were some company-specific issues which have hurt the healthcare sector, that down 3%. Global property also flat, also mostly invested in the US. And then the higher for long interest rates have hurt that asset class slightly negative in a rand basis year to date. But otherwise, everything up high single digits, if not double digits. So, a fantastic start to the year, fantastic start to balanced funds. We have very, very strong returns for our balanced funds year to date, despite all the risks that we've seen. Yeah, a great start to the year. A surprising start to the year, I must say. So how has this impacted the funds? Looking over the last month, you can see the Signia Itrix MSCI Emerging Markets 50 ETF up in first place with a fantastic 7% return. This has worked very well for our funds. We've switched last month some of our South Africa exposure into emerging markets, and we continue to do that this month, and I'll talk more about that later. And then US technology taking the next four spots, FANG in second and third place, fourth RR in fourth and fifth place. And the US itself has not done very well. As you can see, there's no US on this top five list. In fact, the broad US market, S&P 500, as you saw on the previous chart, down for the year to date. But the global basis of the FANG stocks, that huge global revenue basis of Netflix and Google, as the dollar has weakened, as it's faced its weakest first half in 50 years, so that automatically translates to stronger earnings for the FANG stocks with their global revenue basis. That, and as we've seen before, in times of high interest rates, those companies are all cash flush. So they are earning more money on their cash reserves, whereas those smaller companies that have debt and not cash, or they are still struggling. So the FANG stocks continue to be resilient no matter what happens in the US, no matter what happens in the world. And that pulled up the Fourth Industrial Revolution Fund, which has got some FANG stocks in it. And then lastly, the US came in third place as a whole, pulled down by the non-FANG stocks. Over 12 months, pretty much similar story to what you saw last month. We've got China in first place. China is really starting to look strong with domestic policy support, and that has buoyed commodities and Chinese tech, both of which are in the South African equity market. So the Signia Itrix Top 40 ETF is up in second place, and the similar unit trust up in fifth place. and South African property stocks up in fourth place, and it's on the back of very strong bond returns, which come in at sixth place. You can't see it, but some very good returns from SA bonds. So SA equities, SA bonds, SA property, all doing very well on the back of strong commodity prices, which are supporting the rand, supporting resources, strong China, and then FANG squeezing in third place there at 25.9%, showing its robustness despite everything that's happening in the rest of the world.
Tonight, I can report to the world that the strikes were a spectacular military success. Iran's key nuclear enrichment facilities have been completely and totally obliterated. Iran, the bully of the Middle East, must now make peace. If they do not, future attacks will be far greater and a lot easier.
Well said, Trump. So we had another big month in June. April, we had the Liberation Day tariffs. Markets fell 20% and recovered to a positive month end. If you looked at the end of the month of April, you would have never known. Likewise, in June, markets didn't fall nearly as much. But despite the US invading Iran, or at least attacking Iran, markets ended up quite strongly for the month. So we were lucky in that the US attack of Iran happened over the weekend, so it gave us lots of weekend time to look at what happened in the markets during the Gulf War and the Iraq War in 1999 and 2003, respectively, and trying to understand what that meant for markets going forward. Now, we didn't expect things to be nearly as bad as those two incidents in both the Iraq War and the Gulf War. S&P 500 equities fell nearly 20% ahead of those wars, or the start of those wars. But this was looking like it was going to be different. Firstly, Israel had and has total airspace dominance over Iran. It's very hard to have any sort of military victory when you don't have any airspace control. Secondly, the impact on the world is a lot less. In fact, the dependency of world growth on oil is 70% lower than it was in 1980. So the world is just a whole lot more resilient to rising oil prices. And as a result, equities weren't expected to fall as much. Thirdly, the US back before 2005 was a big importer of oil. US used to import 12 million barrels a day, and a quarter of that was from the Middle East. Now, the US exports energy and oil. So the impact on the US is far more different. In fact, from a terms of trade perspective, the US is going to be a beneficiary of a higher oil price, not hurt by it. Fourthly, OPEC has 6 million barrels a day of spare capacity. So even if there was some constraints in supply, it was unlikely it was going to have a huge impact on oil. And lastly, 90% of Iran's oil production is sold to China. And Iran and China are close allies. As a South Africa, I mean, Iran is part of the BRICS. It's one of us. So it's unlikely that Iran was going to choke off any supplies to China and cut off its nose to spite its face, so to speak. So we weren't expecting the impact on the world to be nearly as bad as it was in the previous two occasions when the US invaded the Middle East. However, a 24-hour ceasefire was also a surprise to us, and that's what happened. 24 hours after Operation Midnight Hammer, that's such a cool name for an operation. 24 hours after Operation Midnight Hammer, Trump and Qatar organized a ceasefire between Israel and Iran. Pretty amazing achievement, and oil fell back to below $70 a barrel, and that was it. Basically a one-day war, and oil prices were back, and markets kept on rallying. So certainly a big event when it happened, but at the end of the month, it's like it never happened. And so with that geopolitical flashpoint behind us, we had to look back at tariffs. Tariffs are still the big uncertainty. The 90-day tariff pause expires on the 9th of July. And Trump has said that he's going to send letters to every country that there are no deals in place with a take it or leave it stance. Basically, whatever he says they're going to do, they're going to get, and it's going to be far worse than if they had negotiated. Fortunately, all the big countries, all the major economies are negotiating. There are about 15 countries that are negotiating with the US. And the countries that are negotiating are likely to see an extension to the 9th of July deadline. So we're not expecting a huge impact from that uncertainty. However, that still leaves the base case of 10% tariffs, broad tariffs, plus the intermediate tariffs on various goods like steel and autos, which will influence the US. And we're looking at the moment, assuming that post the 9th of July, countries just are left with where we're standing right now, 10% broad tariffs plus some intermediate tariffs. The effective US tariff will be about 15%, which is the biggest increase in decades. Now, in May, the inflation pass-through was limited, and I'll go into that in more detail, but we are expecting that inflation pass-through to come through over the next 2 or 3 months. And that means higher inflation, which means higher interest rates, and we're back to what we had coming out of COVID. It's the higher for longer interest rate regime, higher for longer inflation regime, which from a US perspective is very good for the FANG stocks and not very good for US growth. From a sectoral perspective, it's actually best for the FANG stocks and not good for any other stocks. And from a dollar perspective, when we saw this exact same thing happening coming out of COVID, it led to a strong dollar, whereas now it's leading to a weak dollar. And the big difference is not so much interest rates, it's about growth. And the US is certainly going to see the biggest decrease to growth out of the global markets. In fact, this is very depressing, and I'll get to it later on. But the only country that's had its growth downgraded as much as the US this year is South Africa. No surprises, but very, very sad. Anyway, the World Bank concurs with the outlook that we're going to see lower growth and higher inflation as a result of tariffs, particularly in the US, possibly other countries if there are reciprocal tariffs of any sort. But focus on the chart on the right there, the top panel. You can see that on the left, we've got advanced economies, and that's basically developed markets. And on the right, there's emerging markets and developing economies, which is basically EMs. And if you look back to the left, you can see there that the January inflation forecasts of the green horizontal bar and the purple bars are the June forecasts from the World Bank. So advanced economies are seeing an increase in their inflation forecasts, whereas emerging markets are actually seeing a decrease in their inflation forecasts. Then moving to the bottom panel, you can see that everyone is unfortunately seeing a growth decrease because of tariffs, but a far bigger influence on developed markets compared to emerging markets. And it's one of the reasons why we have continued our switch out of South Africa into emerging markets. And South Africa is an EM, so you might say, well, we're switching EM to EMs, but I'll explain more about that so when we get to the South Africa slide. But as a whole, things are looking pretty poor. We're very much in the low growth, low return outlook. And that's just amazing that equity markets around the world, even the US, are at all-time highs. It's just phenomenal. All-time highs on equity markets around the world. And yet the World Bank is forecasting the weakest non-recessionary growth this year, 2025, since 2008. Not only that, but they're forecasting that 2020s as a whole will see the weakest growth since 1960s. That's just absolutely incredible. A 6-decade low from a growth perspective. And within that six decades, the lowest singular year since 2008. I mean, things are definitely tough. And that's assuming best case scenario of all the geopolitical flashpoints and the wars that we've seen stay subdued, and the tariffs that we're going to see aren't any higher than the base case scenario, which is basically a Goldilocks scenario. So the world markets really are pricing in Goldilocks, and we are a little bit more cautious than markets are. And I'll also talk to that on the outlook slide. Why have markets rallied so hard when there's so many risks out there? But let's move on to the US because they are the biggest beneficiary, if you want to call it that, of tariffs. Trump would say they're a beneficiary. Others would say they're most harmed. But it's definitely impacting the Fed's outlook.
it takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed.
So there you have it, Fed Chair Jeremy Powell, for the moment, at least until May 2026, when he's going to be replaced. We're not sure by who, but there's a lot of speculation. It's just another reason why the dollar has weakened, because many people expect Trump to put a dove in Powell's place, and as a result have much weaker interest rates, lower real yields, which will lead to a weaker dollar. But before I get ahead of myself, back to Powell's statement. Very concerned about the pass-through effects of inflation, saying that they're not going to happen now, they'll happen over the next 2 to 3 months. The Fed can't ignore those impacts. Now, the Fed faces a very difficult outlook. They've got slowing growth, they've got potentially rising inflation, and what to do. So an outcome perspective, the two cuts, or the dot plots, which forecast two cuts over the remainder of 2025, remained in place. Although certainly, if you look at the media numbers in terms of how many people voted for that, it did barely scrape through. So we're talking it just barely scraped through as two cuts. But in the discussion afterwards, Powell went to extremes to say that the US is looking very strong from an economic perspective, from a growth perspective, from an employment perspective, and that his major concern right now is inflation and not employment, which means that he's going to be staying flat for longer, with the first cut probably only in December, compared to markets which are pricing in 3 cuts. So we do think that there is some discrepancy here. It can be very difficult for Powell to cut when inflation is rising. But will inflation rise, and by how much? That's the big question. So we try to answer that in the next slide. So if you analyze the May CPI number, for the 4th time in a row, inflation came in below expectations. And that's what got markets excited. That's why markets have rallied. They're saying, oh, tariffs are in place and there's no inflation. Trump is right. We can have our cake and eat it, and we don't have to worry about inflation pass through. But Powell said, no, that's not the case. And the Fed's beige book says also that's not the case. In fact, the beige book says that firms expect to pass on inflation within the next 3 months. But there are other indicators as well. Firstly, companies have inventory on hand, normally about 1 month's supply. So that allows them, and certainly allowed them in the month of May, to sell what they had on stock at lower prices to avoid losing market share. Not only that, but any imports that were on board a ship before the 5th of April tariff increase were exempt from that tariff, which basically meant that until the 27th of May, all those imports weren't charged tariffs. So quite a few reasons why there's a delay in that number. But if you look at the charts on the right, inflation is definitely on its way. This chart looks at US customs and excise taxes. It's a monthly number that's annualized, but you can see there's a huge increase from around $100 billion to nearly $300 billion over the last month. So those tariffs are being collected. The companies are going to have to pass them on once they run out of inventory, once they run out of goods that were on board ships, and that's going to lead to an inflation increase. In fact, JP Morgan estimates that US inflation could rise to 5.4% in the 3rd quarter. That's a big number. That means that US real yields will be negative, i.e. inflation will be higher than the Fed rate. There's no way the Fed can cut when inflation is higher than its yield. And yes, we can all hope for transitory inflation. That's something we all learned the hard way during COVID, that it doesn't always work out that way. So companies don't always cut prices once inflation effect has come through. In fact, they generally are quite sticky, those prices. And when companies realize they can push on prices and not lose market share, well, they get bold to push on further increases. So the whole transitory inflation thing is another thing that is definitely circumspect. Moving back to the inflation number in May, one of the reasons that the number was below expectations was not only that there was a delay in the pass-through of some inflation, but other parts of the inflation basket actually saw deflation. And that was particularly in areas that are exposed to cyclical consumer spend. So recreational services, durable goods, all had deflation in the month of May, which means that the consumer in the US is definitely being more conservative than they have been at the start of the year. And that's something to keep a close eye on. Not only that data point, but we saw May retail sales were negative and below expectations. June consumer confidence was the softest we've seen in over a decade. Manufacturing data also slowed, which confirms slowing demand. And jobless claims have climbed to a 3.5-year high. So we're definitely seeing a slowdown from the US as a result of a very strong consumer at the start of the year. And a lot of that was because they were trying to buy ahead of tariffs. And now that tariffs are on their way, they are normalizing the spend, and that's seeing a slowdown. And that's exactly what we expected. We just expected markets to be a bit more concerned when that slowdown came through. And so far, markets are not concerned at all. It's just another worry that markets are climbing. But looking broadly, we are neutral, the US, in our global equity basket. Neutral Europe, neutral Japan, neutral the US. We are overweight emerging markets. As I've said, we've switched some South African exposure into emerging markets, both on the debt side and the equity side. But I'll get to that on the EM slide. So June was also an opportunity for the ECB to grab some headlines. We had European Central Bank President Christine Lagarde. She was calling for the euro to be the new global reserve currency. She said the dollar has had its time. It's now the time for the euro. And the IMF managing director, Kristalina, got onto the bandwagon and similarly called for the euro to be the new global reserve currency. Here she's saying there is a great opportunity for the euro to play a bigger role globally. And this makes sense. Certainly, right now, the dollar is weakening. As I said, it's had the weakest start to the year in 50 years. And why is it weak? Well, certainly because, well, I think mostly because of slowing US growth. But there's also concerns about ballooning debt. The debt to GDP ratio is going to climb to just unbelievable levels. And part of that is because of the big, beautiful bill, which is about to be passed. We're still waiting for that. And some of that's uncertainty. And then there's speculation as to who's going to replace Jeremy Powell, excuse me, as the new Fed chair in May 2026. So lots of reasons why the dollar has been weak. That said, I think besides trying to grab some headlines, it's a little bit early for the EU to start to claim they're going to be the new reserve, global reserve currency. They just can't. There's so many reasons they can't. First of all, they don't have a unified capital market. They don't have a centralized fiscal authority. I mean, that's a big one. If Texas borrows money and New York has extra money, that no one cares. It's just US. But if Germany borrows money and Greece has extra money, well, that's a big issue. And there's no way of trying to offset those numbers. There's no cohesive banking union. Each country has its own banking system and banking policies. There's no combined treasury market. Germany's got its own bonds. Greece has got its own bonds. And as a result, the liquidity in that sovereign debt is insignificant compared to the US. And you need a really strong bond market if you want to have a strong global reserve currency. So the EU grabbing some headlines, and certainly we do think that the dollar could continue to weaken a little bit further, and maybe the euro could even strengthen a little bit more, but we think the euro has done most of its strengthening, and there's certainly no time soon will they be replacing the dollar. Now, another reason why we don't think the euro's got much further strength in it is just that its growth outlook is still poor. Even though US growth has been downgraded, the US is still expected to grow at about 1.6% this year. The ECB expects Europe to grow at 0.9%. So nearly half what the US is expected to grow at. And there are a lot of risks. If you look at the charts on the right, The green line is Euro area, and the purple line is the UK. And you can see there a huge fall off in exports as the front running of tariffs normalizes. So a big spike in UK and Euro exports into the US as companies bought inventory ahead of tariffs. And now that tariffs are in place, that is collapsing. So that's going to come through in the third quarter of 2025, and I think it's going to lead to slightly weaker growth than the ECB expects. Not only that, but there are definitely risks between Russia and Ukraine. I mean, that's certainly not any closer to a peace accord or a ceasefire than it has been. And then lastly, although the EU and the US are negotiating, so we're not expecting any bad news on the 9th of July. I think it's going to take longer than expected for the EU and the US to reach an agreement. And this is just based on what happened after Brexit. The UK and the EU took forever to reach an agreement. So quite a few risks to the EU and quite a few structural impediments to the EU being great compared to the US, which just has a lot of inbuilt strengths that, despite what Trump is doing, mean that growth there will remain strong, even if it's weaker than expected. Okay, so let's move on to China.
Mr. Secretary, you just said that you're going to announce a whole bunch of deals over the course of the next week. With what countries? And does that include the China deal the president suggested was signed yesterday? What is that?
So the China deal, we inked the deal. You remember we had a trip to Geneva, and then that was being slow played. We got back together in London, and that deal was signed and sealed 2 days ago.
Thank you, Howard. Certainly, the US-China trade deal was a bit like a bad rom-com this month. It was on and off and on and off and on again, and no one was quite sure where it would end up. But it ended up that they signed a deal, and the deal has resulted in 55% tariffs to China, which on an effective basis is actually only 33%. So China walked away pretty much a winner in those negotiations. They did agree to start exporting rare earths to the US. That was certainly China's strong negotiating point. But the more difficult details have not been ironed out. And certainly there's no final comprehensive deal which has been announced or released. So issues like the fentanyl exports, which is a big problem for Trump, or Taiwan, which is a big problem for China, there's no agreement on those details yet. And that's kind of what we're seeing in all these deals, and what we're probably going to expect to see after the 9th of July. There will be an extension for those that are negotiating. It'll be an extension at 10% for most of the world and 33% for China, plus some intermediate autos and steel tariffs. But the sticky issues just take years to negotiate and possibly never will be negotiated. So, there's just no way that trade negotiations can be held hostage by these other details. So one of the reasons markets are running is that they expect the 10% and 33% to be the likely outcome for the foreseeable future. It just means that tariffs are here to stay, and that's still a 15% effective tariff on the US, which means slowing US growth and higher US inflation. Meanwhile, China is certainly looking like a winner. They definitely used rare earths to get a good deal out of the trade negotiations. And not only that, but finally, policy support is gaining traction. Now, I'm not going to deny the property sector remains weak. In fact, I was expecting the property sector to at least break even, but we have seen in the last quarter, property is still a slight drag to the economy. But we've also had slightly better than expected exports out of China, which has balanced that outlook. And then the domestic sector is looking really, really strong on the back of the policy support. So the M1 money supply is a leading indicator of economic activity, and that's at the fastest growth in over a year. So that's great for China's growth forecast. And then retail sales rose to a 17-month high, which is just phenomenal. And that was bolstered by the subsidies for durable goods, which the US had a while ago. It was called cash for clunkers. Basically, you can hand in your old toaster and you get a voucher to buy a new toaster. And if you look at the charts on the right there, you can see the huge increase in household appliances and audiovisual equipment, massive increase in furniture sales and consumer appliances, less of an impact on autos, but overall retail sales looking really, really nice and certainly recovering. And that's going to help consumer confidence and domestic consumption in China recover. And that's really what we need to see in China is more domestic confidence from the consumer and more domestic spend from the consumer. Because China's still got the highest savings rates in the world, which is great for China as a whole. It means that their debt issues aren't a concern, but it does mean that their growth is limited by the domestic spend. Excuse me. Okay, so China's looking strong. Part of the reasons why we continue to increase our exposure to emerging markets. But it's not just China that is looking strong. Emerging markets as a whole are looking strong. And that's for a number of reasons. Firstly, the dollar continues to weaken, and a weak dollar is very good for emerging markets because it automatically results in lower finance costs because majority of EM debt financing for external debt financing is in dollars. So as the dollar weakens, suddenly your balance sheet debt just shrinks immediately, which is wonderful. Not only that, but a weak dollar leads to strong commodity prices, and most emerging markets are tied to commodity exports, so they also benefit. Then there's actually an indirect benefit to emerging markets because of Trump's tariffs. A lot of EMs are benefiting from what has been called transshipments. That's just the word, like we had transitory inflation. Now we've got transshipments. And that refers to the fact that a lot of Chinese exports, instead of going straight from China to the US, are going from China to an emerging market. It's being repackaged, relabeled, and being sent to the US to avoid Chinese tariffs. So that's helping the global economy remain active because supply chains remain in place. It adds a little bit of a cost, but not as much of a cost as the tariffs. And EMs benefit, and so does the US consumer. Not only that, but if we go back to the first slide with the World Bank outlook, you saw there that emerging markets are not only benefiting from increased growth relative to DMs, but reduced inflation. And that's very important because reduced inflation for emerging markets means that EM central banks can cut rates, which again is another support for businesses. So suddenly you've got an emerging market business, it's paying a lot less on its interest, its global interest for trade finance, and now it's because the dollar has weakened, and now it's paying a lot less on local debt because the central banks are able to cut rates. And finally, we're already seeing these benefits flowing through to emerging market companies where over the last quarter, EM earnings are growing faster than US earnings. And that's certainly a great catalyst. And one of the reasons why we have increased not only emerging market equities, but emerging market debt. And we continue to see EM FX will strengthen and be the biggest beneficiary of a weakening dollar. Okay, on to South Africa. Now, I've got some good news and I've got a lot of bad news, unfortunately. But we did have our deputy president visit Russia during the month. So that was interesting foreign policy that was going on. Meanwhile, we had some more GNU instability as President Ramaphosa had a surprise cabinet shakeup and fired a DA cabinet member, DA Deputy Minister of Trade and Industry, Andrew Whitfield, and that led to a lot of, again, bad rom-com. Is the GNU off again? Is it on again? And some instability, which saw the rand weaken a bit and then strengthen a bit. But generally, things are not looking good in South Africa, which is why we continue to reduce our exposure here and prefer emerging markets. Yes, South Africa continues to benefit from being an emerging market, and that's why it's a difficult call. The rand continues to strengthen, and we think it will continue to strengthen. And the commodity rally, like all the EMs, benefits South Africa. So despite what we're doing, we're probably going to see better revenue collections when it comes to the budget as a result of high gold prices, high platinum prices, high copper prices, all of which means increased tax revenues and lower debt to GDP, which is all fantastic. But that's despite what South Africa is doing, and that all emerging markets benefit from. So let's look at some of the specific actions we had during the month. We saw the new IT procurement rules were gazetted in June, which means that government departments can now access IT services without having to use the State Information Technology Agency. This is a really good point. And hopefully we can start to see some much better systems and unified systems across government departments. Then, even more importantly, the FATF, the Financial Action Task Force, has granted South Africa an on-site assessment, and that means that by October, South Africa may be removed from the grey list. That'd be awesome. So two great data points that are good news for South Africa. However, as I mentioned earlier, South Africa Standard Bank says that the downgrade to South Africa's growth in 2005, excuse me, was the 6th worst out of the 22 EM and DM countries that they cover. And it was actually worse than the downgrade to US growth. And that's just embarrassing. We're not facing tariff like the US is facing. We shouldn't be seeing those slowdowns. But we've got our own issues, and we desperately need reforms. And without those reforms, we're going to continue to miss out on the commodity rally. So yes, copper price is up 30%, gold year-to-date, gold's up 25%, platinum's up 50%, all of which should be leading to huge revenue increases for SARS. But we are definitely missing out on some of that rally. The OECD noted that Transnet and a general lack of reforms are causing South Africa to miss out on the commodity rally. Q1 2025 growth stalled at 0.1%, as the ongoing incapacity at Transnet severely limits growth. It's the quote from OECD. Not only that, but we had mining production was down 7.7% in April, following March's 2.5% fall in year-on-year. So here you've got platinum prices up 50%, and our production levels are collapsing. Why? High input prices, labor challenges, illegal mining, and logistic bottlenecks. So unfortunately, we should be doing well, like all emerging markets, and we are going to do okay. But despite ourselves, and unfortunately, because of what we're not doing as well as we could be doing. What else? So how does that feed through into the markets? So as I said, commodity prices up strongly. That means that our resource sector is up 50% year to date, 5-0. And that has pushed up the South African equity market massively. In fact, it's been the primary driver of SA equity returns year to date. Industrials up about 12%, and that's pretty much because of Naspers and Process on the back of Chinese tech. But SA Inc., retailers, banks, property stocks were all flat because of a lack of reforms, because of concerns of GNU, and just because, most importantly, there is no growth in South Africa. 0.1% growth in first quarter, and the OECD blaming a lack of reforms. Now, part of that lack of reforms is resulting in the wage bill, which continues to increase. Bottom right-hand chart just shows the budget from 2022, 2023, 2024, 2025. And what you can see is that at each budget, the National Treasury forecasts that the wage bill is going to plateau. And what happens? Well, surprise, surprise, it doesn't. So fool me once, shame on you. Fool me twice, fool me 3 times, fool me 4 times, fool me 5 times. Well, possibly shame on me. And unfortunately, when you have a wage bill that's growing so rapidly, you need to finance it somewhere. And the only way to do that is raising taxes. You can see the top panel, which shows that personal income taxes have doubled over the last 40 years, from 9% of disposable income to nearly 18% of disposable income. And that just cripples the South African consumer, destroys the South African middle class. Now, there was an interesting statement this month from Capitec's CEO, who said, don't worry, everything's okay in South Africa because our informal sector is huge. In fact, they said it's about 5 times the size of the official record. And if you read Signals, which is coming out later today, there's an interesting section from Professor Haroon, who looks at that and says that actually that's not the case. Our informal sector is actually not bigger than we think. But even if it were, the important aspect is we need people to pay taxes. We need people to contribute so that the infrastructure of South Africa stops collapsing. So right now you've got 8 million, under 8 million personal income taxpayers supporting a countrywide infrastructure that has to support 64 million people. It's just impossible. Likewise, we've got ratepayers that are supporting a huge informal sector. So it doesn't matter how big that informal sector is. What you need is people to start paying their rates. In Johannesburg, 80% of rates are in arrears. 80%, that's just a huge, huge number. So what we need is to create jobs so that people can start paying or contributing towards the infrastructure of the country so that we can actually build that infrastructure again and stop it collapsing. But you can't create jobs without creating growth. And you can't create growth without reforms. And without reforms, we're stuck in the 1% low growth, which means that our debt to GDP is going to continue to grow. And that means that we're going to remain junk and from in the eyes of the credit rating agencies, and our debt is going to get even more expensive, which is not good for South African bonds. That said, and that's our base case, and that's why we have moved out of South African assets into emerging markets. There is a slight ray of sunshine, and that's the fact that the SOB is proposing a new inflation target or at least lowering the inflation bands from 3 to 6 by 1% to 2 to 5. And that would allow a lower nominal interest rate, which would have benefits, a wide variety of benefits. Of course, it's also got challenges, and the biggest challenge there is how it impacts the government wage bill and how it impacts administered prices. Because as you can see in the bottom right-hand chart, inflation, no matter what it was, hasn't allowed the government to negotiate better wages or better administered prices. So yes, it's a great concept, and we do think that it could lead to some upside surprises to SA rates and SA assets, but it needs the political will to result in lower wage increases and lower administered prices, and that's difficult to achieve. So for the moment, we remain very cautious about South Africa. Okay, final slide before we move on to Q&A. And that's just our overall outlook and positioning. And I've got some interesting data points on those of you who are looking to get into the EU defense sector. Because NATO finally made an agreement with strong, very strong support from Trump, and he was pretty much sitting on them in an armbar jiu-jitsu move, but he got NATO to agree on new defense spending of 5% of GDP over the next decade. That is very important, and will certainly lead to a lot of increased spend in the defense sector. So should we be looking at buying? There's a new EU defense ETF, which is out from iShares. Should we be looking at buying that? I'll talk to you a bit more about that at the bottom of the slide. But first of all, what's our overview for the rest of the year? We don't forecast a recession. We are cautious, but we don't forecast a recession, which means markets should continue to grow and end the year higher. Maybe not higher from these levels, but certainly higher or positive for the year as a whole. Why? Well, there's a lot of positive reasons that are behind that call. Firstly, the US consumer remains in a great shape, low debt, just in terms of overall debt levels, including property debt. Financial conditions have eased significantly. In fact, we've got some of the easiest financial conditions in the last 2 years. And US long-term inflation expectations are stable, which means the Fed doesn't have to panic. So that means that financial conditions can stay easy. And that means the US consumer will probably certainly slow. We definitely think the US consumer is going to slow and growth will slow, but not shrink, not move into a recession. Not only that, but there is a roughly 2% of GDP near-term fiscal thrust in Germany and China. Germany on that infrastructure fund they announced over the next 12 years, and China just with their local domestic support. So overall, there's enough happening on the fringes to keep the slowdown that's happening from moving into recession. But there definitely are risks. Big risks are tariffs, and to what extent the 9th of July is just a rollover of about the 10% broad tariff. And markets are certainly only expecting that 10% plus intermediate goods being rolled over. If there's anything higher than that, that will definitely set markets back. And then the other big risk is what that means for inflation. So as I said, JP Morgan expects US inflation to be 5.4% in the third quarter. Bloomberg consensus estimate is about 3.5%. So there's a big divergence on that view. And if inflation is higher than expected, markets are going to run for the hills. I promise you that right now. So everyone's going to be watching this inflation number very closely to see, yes, inflation should rise, but how much is going to rise? And if it rises more than expected, markets are going to have a big wobble. If it rises less than expected, well, things are just going to carry on tracking from here. But that's, to me, the biggest risk, and that's why I remain cautious, is inflation is going to come through from tariffs. Not all of it. Companies will definitely absorb some, but there will be inflation passed through. And yes, it's mostly goods, not services. But even in the May number, we saw some inflation from tariffs being passed through in the services sector. So, like COVID, people jump on the bandwagon and use this as an excuse. So it's not guaranteed that it won't be a broader inflation. So that's the big risk. Now, looking at the outlook, in the past, when there's been a risk-off event, the dollar has always strengthened and US bond yields have fallen. But we've seen it in the Liberation Day tariffs in April, and we've seen it now in the one-day war between the US and Iran. The dollar weakened and US bond yields went up. Now, the bond yields going up wasn't actually too much of a surprise because the oil price went up, which is inflationary, but the dollar weakening was a surprise, and that's just because of all the reasons I've said. Slowing US growth is the main one, but also some concerns about who the Fed is going to replace Powell with next year. And generally, we do think that the dollar is going to continue to weaken, which is good for emerging markets. But at the same time, it's too soon for Europe to take over the mantle of the global reserve currency of the world. China as well is too soon, as is Japan. So yes, there will be the slow move that we've seen over the last 20 years. Over the last 20 years, US reserve currency has dropped from 70% to 58%, and those have all moved into the pound, the yen, the Australian dollar, the renminbi, and that's going to continue, but on the fringes. And then overall, even though we're expecting the slowdown to happen, we think that emerging markets will remain resilient because of domestic policy support in China, because of the transshipments, which is the beneficiary of global supply chain realignment, because of the benefits of a weak dollar, because of the benefits of strong commodity prices, and because of the benefits of low inflation and EMs, which allows policy flexibility. All good news for EM debt and EM equities, including South Africa to some extent. Now, the surprising thing, and I really found this very interesting, is the chart on the right. The chart on the right shows the correlation between industrial metals and global military spending increase. You can see the huge increase, or huge correlation between global military spend and industrial prices. Now, I'm not too sure what the reason for that is. Possibly it's because actual weapons and ammunition requires a lot of copper and aluminium and other metals to be built, or possibly it's the fact that when you need a lot of weapons and military spend, it results in destruction. And the rebuilding of those cities requires, those commodity prices. Or maybe it's both. I'm not sure. But it certainly is another reason to be optimistic on commodity prices, and as a result, optimistic on emerging markets, which I think is a cheaper entry to the global military spend. Why? Well, you can obviously access this new iShares EU defense ETF, and we certainly have looked at it. But thanks to some interesting research from one of our portfolio managers, it's a bit concerning what goes into that ETF. So the number one holding in that ETF, the EU defense ETF, is 20%. So 1/5 of the ETF is one stock. It's called Rheinmetall. It is up 400% over the last 6 months, 400%. And it's just jumped into the Stocks 50 index at the number 19th position. So top half of the Stocks 50 index. That just shows huge price momentum behind that sector. And possibly that momentum is going to continue. And those of you with very nimble fingers are possibly going to get involved. But we think that too much good news is priced in. And we are talking about a slow increase. NATO is going to increase their defense spend to 5%. That's excluding Spain, who are now on Trump's naughty list, over the next decade. A decade's a long time. And in the short term, a lot of that spend has to go to the US because Europe just doesn't have that many suppliers, which is why we've seen these big price increases, because money is trying to chase what isn't there yet and getting ahead of itself. So definitely some big tailwinds to the sector. I'm not going to argue that, but also some pretty strong price moves in that area, which is why we prefer to get exposure indirectly through industrial metals, which benefits commodity prices and emerging markets, and the rand. And it is one of the reasons why the rand has strengthened, looking very strong today as it continues. But fortunately, all emerging markets are doing well, and EM equities having a great month this month. So I showed you far better than SA equities. So that rotation is doing quite nicely. And it's not so much a specific call as it is a mean reversion call. If you look back over the last 20 years, there's a very strong mean reversion tendency between SA and emerging markets. And right now, SA is looking quite expensive compared to EM. So we do think that will mean revert, given the slow growth in South Africa and the strong growth we're seeing in the rest of emerging markets. Okay, that is it for the outlook. Let's move on to some Q&A. Apologies for all the coughing. The winter flu has got hold of me. Okay. Okay, great. First question. Hi, when, where, and how can we access the Bitcoin ETF fund? Okay. So we'll be putting out a notice tomorrow for a webinar that I'll be hosting on the 22nd of July, which talks about our new Bitcoin Plus Fund. It's the Signia Life Bitcoin Plus Fund, which is already live, and it's available to living annuities and sinking funds, or endowments, if you'd rather call them endowments, and that is already live. When it comes to an ETF, no one can launch an ETF in South Africa until the JSE creates the rules that allow that to happen, and the JSE haven't even agreed on what those rules look like. So we're hoping there could be an ETF, a Bitcoin ETF in South Africa by the middle of 2026, but that's a hope. So unfortunately, that's not available. But if you want to get involved right now, you can through the Signia Life Bitcoin Plus fund, but that unfortunately is not available for any funds that are Regulation 28 compliant. So whether it's a retirement annuity, pension fund, provident fund, none of those can invest in this because the Regulation 28 still prohibits the investment of Bitcoin and all crypto assets. George says, can you include SA property going forward on this slide, George? In fact, I'm happy to do that. I will include SA property. One of the reasons I haven't is that SA property generally moves in sync with SA Inc. So it's got a high correlation to SA retailers, SA banks, SA insurance companies. And so if you actually wanted to do some sort of principal component analysis, you should have the Resi and the Indy and the FINI, and you should include property, which is a financial stock in the FINI. But people don't look at markets that way. So, and SA property is only 4% of the alls. But sure, happy to do that. It is something that is worth keeping an eye on. SA property remains cheap. It remains at a discount to its NAV, but there are some big structural headwinds that remain in place for SA property. We still haven't got over the COVID work from home issues, and not just that, it's just the slow growth. This month alone, we saw further closure of stores from Spar, from Pick n Pay, and I think Dis-Chem. So it's just, when stores are closing because there's no demand, because there's no growth, because there's no jobs, you end up with these huge retail huge retail centers with a lot of vacancies. So yeah, we are concerned about the overall structural outlook for SA property. Hi, Bradley. Thank you. Pleasure. Have you changed your mind yet about the space? Do you own any cryptocurrency, Bradley? It's a great question. Pretty much the entire investment team has got involved in our fund, our crypto fund. They're investing well, via a sinking fund, so the 5-year lock-in, because they can't put their RA into it. But no, I haven't seen the light yet when it comes to Bitcoin or crypto. I am very interested to see the big discrepancy year to date in Bitcoin, which seems to have been very resilient, and the altcoins, which have basically just collapsed and destroyed hundreds of billions of dollars. Not only that, but I think Bitcoin's up maybe 15% year to date, with gold up 25% year to date. So also some discrepancy as to whether Bitcoin is a risk on or risk off asset class. My view remains firmly that gold is actually a risk on asset class. It gives you some diversification against geopolitical events, but and inflation. But if we end up in a recessionary scenario, the only asset class that can actually go up in that scenario is developed market bonds, and that's because DM central banks will cut rates, which results in higher prices, whereas the rest of the world will suck out liquidity from all asset classes, and that's going to lead to everything falling. So one of the reasons that I'm even though I'm cautious, one of the reasons I'm comfortable being long equities at the moment is because gold continues to rally. Once gold starts to lose momentum, that'll be the key indicator that I'm looking at that the risk on rally is off. So I know it sounds rather counterintuitive, but most asset classes right now are just being driven by excess liquidity, and that is likely to continue. Sean says, your comment, low growth versus all-time market highs. How does an investor digest or act on this reality if markets aren't representative, as the statement is confusing and conflicting? Sean, you are spot on. So, and I did say I'd touch on it, so apologies for not touching on that earlier. So we have seen this confusion. No, sorry, let me start again. Markets tend to climb a wall of worries. That's an old cliche. So yes, markets do go up even when there are risks. But we have seen a very confusing rally this year with massive risks and markets still rallying, and huge declines, not only in GDP growth, but 3-month and 6-month earning revisions from a bottom-up perspective are also negative across the board. In fact, the only regions, if you look at UK, US, Japan, emerging markets, China, South Africa, the only regions that are seeing positive bottom-up ERs or earnings revisions is EMs and FANG. That's about it. But the majority of markets are getting expensive day by day, or getting more expensive day by day, just because the forward earnings are falling. So you've got forward earnings falling, you've got GDP growth falling, and you've got markets going up. Why? Well, it comes down to two things. It's this excess liquidity that I spoken about earlier. When there's lots of money, that money has to go somewhere. Right now, that money is too scared to be in cash because they're worried that cash will lose its inflation protection because of the inflation that's coming towards the US. But in addition, it's this just the huge sorry, the flu's got to the focusing on my brain. So it's the huge liquidity which is driving markets, and the other factor. So that's why I'm keeping my eye on gold as an indicator for liquidity. But the other thing is AI. Now, AI is resulting in a lot more systematic funds driving markets. So there's a great chart which Goldman Sachs put out, and that shows overall underweights grouped by discretionary investors, which would include Signia. We have a discretionary process to whether we're overweight or underweight, and systematic processes, which are driven by quant funds, AI funds, risk parity funds, vol control funds, basically any systematic process. And discretionary investors are underweight, whereas systematic investors became very underweight in April when markets fell, because systematic funds have to sell into a falling market, but they've got to then buy back as the market recovers and as volatility drops. And we're seeing that continue. So from the April lows, we're still seeing markets being driven by systematic and AI-driven strategies, which are forced to buy as markets rise. So you don't want to bet against the trend, but for now, the trend right now is positive, but we're seeing huge liquidity and systematic investors driving the market up. So we remain cautious, excuse me, and watching those two indicators: systematic demand and gold price, to see when it'll be time to get really, really cautious. Mr. Nika says, is this the same Fed that stated that Biden inflation was transitory? Powell has little or no credibility, especially when he cut rates during Biden's term, even when inflation was much higher. You spot on. It's one of the reasons why the dollar has weakened, because there are concerns that Powell is dovish. But I think the concerns are that whoever replaces Powell is going to be even more dovish. Johan says, Kyle, the customs chart is an annualized chart. It is not so that higher tariffs on China was in place for a short time, a few days. That would mean the annualized number extrapolates the effect out of proportion. So long as deals get put into place, the total actual customs excise should be far lower than the chart indicates. No, Johan, you're spot on. That chart does include higher tariffs for various regions that were put in place for a few days. But then there's also the risk that it also excludes some of the tariffs that were put in place later, like the 50% steel tariff. So yeah, good point. That maybe it's overstating it slightly, but I think there's just generally so much uncertainty that we don't know, and that is the big call: is will inflation be higher? Will it be closer to the JP Morgan number of 5.4, or closer to the consensus number? And as a result, what will the Fed have to do? And I think right now my base case is we've got the systematic funds buying. We've got this huge wall of liquidity buying. Inflation for the fourth month in a row is lower than expected. I think the catalyst that might change all of that, introduce volatility, which leads to markets falling, would be higher than expected inflation. Even if it isn't as high as 5.4, if it's higher than expected, that will lead to a lot of concern. Mr. Naka, good point on Trump. Anonymous. So Anonymous is accusing me of loving Trump. I haven't been accused in previous webinars of hating Trump. I do try and stay Trump neutral and just look at the actual economic impacts. Actually, this month, funny enough, my plan was to not have any slides or any of the visual media that refer to Trump, but it's just hard to avoid when he's so influential and just doesn't stop tweeting. So your points are noted. Craig says, pleasure, Craig. Does Cigna have representation at Treasury committees, i.e., do you get to state your points, required growth, jobs, etc.? Craig, we are very fortunate to have Professor Hurin Borat, who's on our investment committee, one of the 5 members of the Cigna investment committee. And he is one of the 19 members of the Presidential Advisory Committee. So certainly we get some influence there, and we get to understand what's happening as a result. So it's great to have that input, and also great that our input can be shared. Hi, Dave. Dave says, is there any merit in the FANG fund and the Fourth Industrial Fund combining? Dave, no, there's not any merit in that. We think it's very important to have both. And that's purely from a market cap diversification perspective. So the FANG fund is right now, anyway, is the top, it tracks the NYSE FANG index quite closely. So it's 10 stocks, 10% each, very concentrated. Fourth Industrial Revolution Fund is tech focused, but it's got about 300 stocks, and there's a cap on the biggest fund at, I think, 6.5%, which tries to give you exposure to the mid cap tech stocks and the small cap tech stocks. So in the environment where you think interest rates are going to be higher for longer, you want to keep your exposure towards FANG, but when you think that the US growth is going to broaden, we're going to see this broad growth recovery, then you want to switch your exposure out of FANG into the Fourth Industrial Revolution. So I think it's quite important that we offer both, so clients can have an informed view as to that economic cycle. Or if you are not too concerned about the cycle, you can have a bit of both and just diversify across the large cap techs and the mid cap techs. Mr. Nika says, are technology-led productivity gains not offsetting some of the inflation impacts of tariffs? Hence, inflation is lower than expected. Certainly. I mean, there are a couple of things that are leading to lower than expected inflation. One of them, I think the biggest one, is deflation out of China. So China is still quite deflationary. And it's one of the reasons why I think inflation could or help inflation going forward. We're also seeing shelter in the US. It continues to fall. So we're going to have deflation out of China, and we're going to have deflation out of shelter, both of which will keep CPI constrained to some extent, and not lead to a much higher number that comes through. Productivity gains, it's difficult to predict. So we might see some gains, we might not. That's more of a longer term impact than so much a shorter term impact. But you're spot on. You've got this uncertainty of tariffs, and that's why the market is rallying on this Goldilocks story. The market believes that inflation pass through is going to be contained because it's only on goods which are 10% of US GDP, manufacturing 10% of US GDP. And we've got Chinese deflation, and we've got productivity gains, all of which should offset that. My counter argument is that this is still a risk. And when it comes to taking the advantage of inflation to push through price increases, those companies who can will. And as we saw, even in May, with some services prices going up on the back of tariffs. So yeah, it is a big uncertainty, but definitely I'm more hawkish on the inflation side than the market is. So what you're saying would definitely be in line with the market is thinking. Thank you. Matthew says, can you expand on the EU defense ETF? So that's just, Matthew, that's an iShares ETF. Cigna is not offering it. We are concerned that that ETF has rallied very, very strongly in the short term. We're not going to offer an ETF of our own that tracks it, and we do not have any exposure to that. But it is available as an iShare if you have dollars offshore. Lundani asks an interesting question. He says, how long do you expect the transshipping boom to last? Trump's presidency? That is an excellent question. I suppose as long as Trump doesn't stamp it out, and I'm sure he'll do his best to try and stamp it out because he wants manufacturing not to be rerouted via other EMs, but to move into the US. But as long as Trump doesn't stamp it out, then it'll definitely last his presidency, or as long as those policies stay. Now, it's interesting that a lot of the Chinese tariffs were put in place in Trump's first term, and Biden didn't unwind them. So the trans-shipping boom, which benefits emerging markets, may last longer than Trump's presidency if they can get away with it. So that's interesting to see. Anonymous says, is it time to get into emerging markets, or is the rally already been priced in? Emerging markets had a very strong month, but we still think there's a lot of further leg room in emerging markets. So, it's a difficult call to make. Basically, we're on the cusp of a 15-year structural change. We had a decade of EMs outperforming DMs when the dollar was weak, which was the early 2000s. Since 2008 till recently, developed markets outperformed EMs because of a strong dollar. So if you believe that this is a turning point in the dollar, that Trump secretly wants a weaker dollar, and he's happy with the weaker dollar, and that the weaker dollar allows Trump to achieve his policies, which it does, well, then certainly we could see a structural change for the US and for EMs, which means that the EM rally could run a lot further than it has. Rian asks, when does the soft suspension for the Signia Fourth Industrial Revolution Global Equity Fund Class A end? Rian, that will only end when Signia has capacity, or the Signia Manco has capacity. Right now, we don't have capacity. However, you can get exposure to global assets through the Plus range, and that is the Bitcoin Plus Fund, the MSCI World Plus Fund, and the Dollar Cash Plus Fund. All of those are not capped at the 40%. So please have a look at those. I did talk about how you can switch between funds in my webinar 2 months ago, which is on our YouTube channel. So have a look at that for more information. Bella says, good day, Kyle. On an unrelated topic, some time ago, you presented and made mention of Medupian solar production. How can I access this material? As I've just said, all our webinars are on our YouTube channel. So just pop onto that and you'll be able to watch the YouTube channel. Peter says, my Signia World Global Living Annuity usually pays out annually in December every year. Would you Signia view change that to a monthly or quarterly payment in light of increasing US inflation, making up plus minus 65% of the fund? Peter, I'm not sure it makes a huge difference whether you pay out annually versus quarterly or monthly. Obviously, if you pay out annually, you are keeping your money exposed to whatever the underlying portfolio is. And to the extent that you have equities in that, you'll get slightly higher growth. And obviously, you're exposed to slightly higher volatility. We always do recommend having some cash buffer. So if you've got a cash buffer built up, then you can afford to do an annual payment. But if you don't have a cash buffer, then it's probably prudent to pay more regularly from that process. Vickers says, you think gold will still go higher? Vickers, as you know, I don't hold gold. I don't hold Bitcoin. I think global liquidity could drive gold higher, but I don't know how much higher or when it'll turn. And my base case is that the next inflation number is going to be worse than expected, and then I think we could see some risk off. So I suppose I expect gold to go higher until we have a bad inflation number. Maybe that's June, maybe that's July. Maybe I'm wrong, and everything that was pointed out earlier, inflation just doesn't appear in the US, and Goldilocks continues, and asset prices continue to rally, and there's no need to be cautious. Mandy says, hi, I maybe missed it. Are you invested in the EU Defense ETF? Mandy, we definitely are not invested in the EU Defense ETF for all the reasons I mentioned. The biggest stock in that ETF is 20%, 1/5 of the ETF, which is up 400% in the last 6 months. Although there's a structural tailwind for the next decade, I think that that's not going to happen. You might get a better entry point if we see a Russia-Ukraine ceasefire or other volatility. But right now, we are preferring just to stay exposed to commodities via emerging markets. Anthony, I hope I've answered my views on gold. Gregory says, would you consider a global energy ETF? Gregory, that's a good question. We have actually considered, when over the weekend, when we were looking at the Gulf War and the Iraq War, one of the defensive plays that we were going to buy was the Signia Atrix UK ETF, because the FTSE 100 has got a large exposure to oil. Shell and BP are in the top 10 of that index. And that index is relatively cheap. It's always seen as a value play because of its large exposure to oil and energy and gas. So if you are wanting exposure, the Signia Atrix UK ETF is definitely one avenue could look at. We are not considering launching a global energy ETF at this point in time. We don't think that oil is in a structural uptrend. We like copper, we like industrial metals, but oil, there's just, I think structurally, the move to renewables, and particularly China, which is seeing decreasing import volumes, that's going to be a headwind to oil. Plus, we've got huge amounts of excess supply from OPEC, and we've got various new regions that are bringing additional new non-OPEC supply online. So the supply-demand imbalance for oil is moving into a surplus. And as a result, I don't think oil or natural gas are going to see long-term upside. Of course, the Russia-Ukraine conflict exists, and there may be volatility and there may be upsides. So, a natural hedge would be to buy those that UK exposure. Krista says, we are seeing big companies closing in South Africa, with Goodyear Tires just announcing the intention to close production in the Eastern Cape. What are your thoughts on the impact of the ZA market economy? I hope I've answered that in the South African sector. The bottom line is we desperately need reforms to create growth, to create investment. So we need reforms to encourage investment and business creation, which will lead to job creation, which will lead to growth, which will lead to improved taxes and a recovery. But we aren't seeing any reforms. In fact, we're seeing more GNU instability, which is why South Africa is an emerging market, and I'm definitely not pretending that China is without its problems. China has massive structural problems, as does many emerging markets. But obviously, living in South Africa, we have an outsized excess proportion investment in South Africa. So being able to diversify into regions that have higher growth, even if they've got their own problems, they're still diversified and growing faster than South Africa. And that's one of the reasons that we are moving out. That and South African equities and bonds have massively outperformed emerging markets over the last 18 months on the back of China and resources. Lundani says, you showed us EU equities. How do I access EU equities? You can access that through the Signia Atrix EU 50 index, the stocks 50 index, and that has exposure to European equities, that ETF. Philly says, if one has capital in FANG.ai and S&P 500, should you stick to it? That unfortunately, I'm going to go with my time frame story. I do think in the short term, while interest rates are higher for longer, it's going to benefit. And while the dollar continues to weaken, both of those short-term momentums are expected to continue. We expect dollar weakness to continue in the short term. We expect interest rates to stay higher for longer in the short term, and that benefits FANG over the S&P 500. Longer term, as US growth broadens and the US recovers, and that all depends on the outcome of the big beautiful bill and other Trump policies. Well, then we could see US mid caps, the small caps, and basically the S&P 493, everything besides the FANG, start to outperform the FANG. In that case, I'd be more excited about S&P 500. Thanks, Johan. I think I've got your question there again. I agree with you. US inflation might be more subdued than expected. I think that's certainly what the market is expecting, that US inflation won't be that bad. Coogan says, in my Signia RA, I've portioned to Signia Fourth Industrial Revolution Fund. Can I change it to FANG? Do I need to get a financial advisor to help me change it? I also have a small portion in bonds. Coogan, you definitely can do switches within your RA on the Signia platform. As long as you stick within the Regulation 28 limits, you can change your holdings on the platform. I think you log into Alchemy and you should be able to do it all online. Oh, Johan asked another great question. Thank you, Johan. Always good questions. So yesterday we had an announcement from Scott Bessent, talking about US Treasury refinancing. So basically what he's saying is that we're expecting a huge wave of debt to come through to the US because we've got this big, beautiful tax bill. Now, there is a debate right now about what, in terms of what that bill means, and some say that it's tax cuts, and some say it's not tax cuts. Basically, the big part of the big, beautiful bill is an extension of the tax cuts that expire this year, I think in November. So if the bill is passed, taxes aren't cut. They are just the tax cuts that are in place will continue. So it's kind of a bad lose-lose situation. Best case scenario, the bill is put in place, which means that tax cuts are rolled over. The consumer is no better off, but at least they aren't worse off because there's no expiration of those tax cuts, in which case taxes will rise. But it also means that debt has to go up quite significantly to fund, and the Congressional Budget Office estimates to be about $3.8 trillion over the next decade to fund those tax cuts. So, it's another reason why the US dollar is weakening is because we have this best case scenario is taxes stay the same, but someone has to find money for it. Anyway, as a result, Scott Bessent yesterday announced that they're trying to finance or find clever ways of financing that. So effectively what they're doing is they've announced a sort of QE in the US. Or I don't remember the name for it, but basically one of the QE tools that was used was instead of financing at the long end, you finance the short end. So you reduce supply of bonds on the long end, which keeps the long end or the bond yields low in the long end and helps bond prices actually rally. And they do all their refinancing in the short end, so they issue a lot of short-term bills. Now, it's not only Scott Bessent that's mentioned this, but Trump's also mentioned it. So it definitely seems to be that the way they are going to deal with this excess debt is by financing in the short term. So we are then moving more into a Japanification story where there's this QE and this blend between what the central bank owns and what the treasury issues, and definitely a blurring of the monetary policy and the fiscal policy. But obviously it makes sense. They want to reduce the cost of this huge debt bill. And if they do it in the short term, they can control the short-term interest rates. Now, at the moment, they can't control it that much because Powell certainly seems to be independent. But just imagine if they put in a Fed governor who believes or listens to Trump and Scott Bessent, and then you have a governor who keeps short-term rates low, even though inflation is rising, just to keep the debt costs low. Well, then you're going to have negative interest rates, and certainly it will help the bill. I'm sorry, that debt interest bill, but it's going to lead to what we've seen in Japan, which is a weakening of the currency. In fact, all of this accelerates the Japanification story that the US is facing. And I didn't expect to see Japanification in the US for some time. we're already seeing Japanification in China and Europe as aging populations have reached that, but the US still has a younger population. And until this year, they still had some immigration. But maybe with immigration falling, and there's anecdotal evidence of that. I'm not claiming that it has fallen, but there is anecdotal evidence that immigration is falling in the first half of 2025. Maybe that's the only answer. Is this sort of QE stealth hiding of debt by merging monetary and fiscal policies, and that's another reason to be concerned about the dollar and to not want to be long the dollar. And I suppose it also then talks to the debasement trade and everyone who likes holding gold and the rest of it. So it definitely something to be watching very closely. Thanks for raising that, Johan. It's a big data point that impacts our longer term views. Pleasure, Gregory. Pleasure, Dave. Andrew says, a few years ago, Signia was very positive towards China EM. Then there was an exit last year. Has this view now changed? I know you're personally very positive on China, Kyle. What's Signia's view? Andrew, you're spot on. So we were very positive on EMs in China. We did change that with the very strong Trump rhetoric and the make US great again. And that worked for that call worked well, rotating out of EM in China into the US because the dollar strengthened. And basically what happened was US exceptionalism driven by the FANG stocks. So we rotated out of EM tech into FANG, Fourth Industrial Revolution, worked beautifully. Now with a weak dollar, we are changing that view. So I must reiterate this. Sorry, excuse me. I still think that the FANG companies are the best companies in the world. They have the largest moat. They have the largest number of customers. It's the easiest for them to sell new products to new customers. The US by far has the best private property laws. So I do believe that US companies are the best companies from an earnings growth perspective over the next forever. However, I am in the short term worried about the dollar, and which is why we're neutral the US. And it's very interesting to see, the last time that EU and Japan outperformed the US was in the early 2000s. If you go back to that period, earnings growth out of European companies was basically in line with US companies. Europe wasn't anything special. The only reason that the Stoxx 50 outperformed the S&P 500 for a couple of years was because of a weak dollar. So it's all about the dollar view, and that's why we're focusing a lot of our macro view on what's going to happen to the dollar. It has been confusing because the Trump and Bessent both came out very strongly saying, listen, so we support a strong dollar, we want a strong dollar, and then they did everything in their power to destroy the dollar. So we're now just learning to ignore what they say and watch what they do, and that's certainly what they're doing is not good for the dollar, and we do expect the dollar weakness to continue. Stephen, I hope I've answered the question on oil prices for the next 12 months. We definitely think structurally more supply than demand, keeping oil relatively stable, mid-70s. Mr. Nike, I read an article that US retailers are absorbing tariffs as seen in low margins to retain customers rather than increasing prices. There's definitely some of that. There'll be a combination of tariff pass-through and lower margins. But lower margins lead to immediately lower earnings, which means lower equity prices. Passing through inflation means consumers spend less, which is a delayed effect on lower earnings and lower equity prices. Either way, equity prices fall. Just one happens faster than the other one. Pleasure, Bronwyn. Pleasure, Bala. Pleasure, Mr. Naka. Thanks, Mandy. Okay, lots of thank you. So I'm sure there'll be a few more questions. Anonymous says, Carl, the reforms you referred to until they are basically, Anonymous says, big business is too complacent or complicit at the expense of SA. Any comment? I think that is the biggest ray of hope or sunshine that I see in South Africa is that corporate South Africa, big business South Africa is the most involved in government that it has been under the ANC leadership. We're seeing the biggest collaboration, still not enough, not nearly enough, because there's some ideological issues with government. But we're seeing the biggest collaboration between government and business that we've ever seen, and that is the only thing that is going to improve growth, is that collaboration and that compliance that big business can apply, so that money is spent wisely and not wasted. So I do think we're moving in the right direction, and I do think that big business is stepping up. It needs to happen more, you're right, but there are ideological issues which are slowing it down. Shimon, I'm not sure what your question refers to. Sean says, does the SA tax industry pay tax? At what level? If not, why not? Sean, yeah, I mean, I was being a bit broad-based when I was saying it. Obviously, everyone in South Africa pays VAT and pays the fuel levy, but you know, it's broader taxes, not just that. We need more people paying personal income tax. We need more people paying rates at the municipal level. You know, what just to harp a little bit on that, what we're seeing is that because people aren't paying taxes in certain areas. SARS has a 500 billion rand backlog of taxes they haven't collected. So they're just squeezing the existing taxpayers. Municipalities, I mean, Joburg, as I mentioned, 80% of their rates are outstanding. So what are they doing? Well, they're just increasing the rates for people who are actually paying. So it's this small base that is getting squeezed more and more and more to cover those who can't pay. So until we create growth and jobs, etc., blah, blah, blah. Anonymous, South Africa is certainly seeing some foreign inflows into our SA equities and our bonds, which is what's driving the currency to some extent. Louise says, China has great emerging healthcare stocks. Will the overweight EM positioning pick those up? Currently, SIG-H is overweight US health. Louise, that's a great point. So the Signia Health Innovation Fund is a purely developed market fund. So we don't have any exposure to India healthcare stocks or Chinese healthcare stocks. However, in our emerging market 50 fund, there is likely to be healthcare stocks in it. More than likely, probably in China more than India, but possibly both. Pleasure, Sean. Pleasure, Diane. Johan, I won't spoil signals, but Prof. Borat will give you all the details in signals today about exactly how he's measuring the informal sector. Just because we are out of time. Pleasure, Benji. Okay. That's it. Thank you, everybody, for joining. Thank you so much for your questions. I really appreciate your time and your input. I hope you have a great July. Stay warm. Enjoy the school holidays. And keep an eye on that inflation number from the US. So it'll definitely be one of the key things that moves markets over the next month. And I will talk to you about that in August. All the best.